Right now, we are witnessing the biggest bubble in history. Not in housing, not in crypto, not even in AI. It's in the one thing holding it all together, and that is leverage. U.S. investors are borrowing money like never before, taking risks in a market that's already blazing hot. And the question is, how long can it last before it all comes crashing down? Now, last month, U.S. investors took on another $67 billion in margin debt, pushing the total to a new record, $1.13 trillion. Now, when I talk about margin debt, that just means investing more money than you have. So putting $100,000 in an investment account and buying $150,000 worth of stocks or crypto or whatever. That extra is margin. It's borrowed money. Now, at the same time that we have this record margin debt, we also have a new wave of 5 times leveraged ETFs being proposed to the Securities and Exchange Commission. So what does all this mean and how is it likely to play out? Well, today I'm going to tell you. Now, investors have nearly doubled their leverage over the last 2 years. And this surge is pretty much just like we saw it after the 2020 pandemic. We had that period of really easy money, crazy low interest rates, stimulus checks going out. And so all this money flooding in sent leverage and speculation through the roof. It was a crazy rally in crypto, in stocks, in all of it. And today, margin debt as a percentage of GDP sits just below that peak we reached in 2021. The same level that we saw before major volatility in stocks and crypto, which of course led to the 2022 bear market. So, in other words, risk appetite is not just high. It is arguably the highest it's ever been. And investors are once again borrowing at unprecedented rates to chase market gains. And it's not just traders. Everyone wants a piece of the AI boom. U.S. households now have a record 52% of their assets in equities. Even at the peak of the dot-com bubble, this figure has never exceeded 48%. It's twice as much exposure as Americans held near the lows of the 2008 crisis. So ordinary investors, not hedge funds, not crazy day traders, ordinary investors are piling into the market, convinced that AI will reshape everything from tech to energy to healthcare. And the stock market has become the new can't-miss opportunity of our times. But right now, Wall Street, as it tends to do, is taking it even further. This month, 5 times leveraged ETFs were announced for the first time ever. So these would track the big stocks, NVIDIA, Apple, Amazon, right, the big players, as well as crypto, Bitcoin, Ethereum. And if they get approved, could go live as early as 2026. And I just want you to think about what 5 times leverage means. If you bought a 5x long NVIDIA ETF and NVIDIA stock fell 10%, which it's done many, many times, you lose 50%. So it's going to amplify profits, and it's also going to amplify pain. And these represent the most aggressive form of speculation the SEC has ever considered allowing. So this explosion in margin debt is showing us just how powerful the momentum trade has become. Investors are betting on continued strength, and for now, that bet has been rewarded. But this kind of leverage does have downsides. When there's lots of borrowed money into the market, people are levered up to the hilt. When markets go up, they go up more and they go up faster. But when they fall further and they collapse harder. Now, we've already seen how dangerous leverage can be. On October 10th, crypto experienced the largest liquidation event in history. Over 1.6 million traders were wiped out in just 24 hours. Not $1.6 million. 1.6 million accounts went to zero. $19 billion in leveraged crypto positions were erased overnight. That's 9 times the previous record. Now, is it because Bitcoin fell 80%? No, it fell 10%. That's the level of leverage that is out there. People are 5, 10, 20x long this stuff. And so that day was a big wake-up call that leverage, sure, it's going to amplify your opportunity, but it can destroy you in an instant. And the speculative fever is not limited to margin debt. It's not limited to crypto. Options volume just in the U.S. hit a record 108 million contracts in a single day last week. 61 million of those were call options, bullish bets that stocks would continue to march higher. Folks, investors are using every tool possible, margin, derivatives, options, ETFs, to take massive exposure in the market. And this amped up greed has gone mainstream. But, and there is a but, despite the mania, I do not believe we are at the top. For one thing, the fundamentals of the big mega cap tech stocks are still relatively sane and in some cases improving. Some of NVIDIA's metrics, their EBITDA, their earnings, in relation to their stock price, is actually getting cheaper. So in other words, even though the stock is going up, their earnings, their revenue is going up faster. So is the market euphoric? Yes. Is it purely irrational? No price is too high? Outright buying frenzy without looking at prices? No, we haven't hit that point yet. We will, but we're not there. Now, some corners of the market are in bubble territory. Quantum computing stocks, for example. We made bundles of money on these stocks this year. Many of them have doubled, tripled, quadrupled in 6-month periods without big increases in sales and profits. Those could easily come down 90%. But the major indexes, and therefore the market, are driven by a handful of enormous companies. NVIDIA's a $5 trillion company. Apple's worth, I think, $3 or $4 trillion. You've got Tesla and Amazon and Google all posting record profits and revenue. So there is still real growth underpinning a lot of this rally. Meanwhile, the macro environment is quietly fueling this entire cycle. While the Fed is cutting interest rates into stagflation, U.S. deficit spending continues to surge despite all these tariffs. Some months the government spends $300 billion more than it brought in. The 2025 deficit estimate just came in at $1.8 trillion. Again, that doesn't mean the government spent $1.8 trillion this year. It means they spent $1.8 trillion more than they have. That's how much debt they've added this year in a record strong economy with huge tariff revenue, with relatively cheap interest rates. It's not going to improve. And all this happening while the U.S. dollar is weakening. That is pushing investors toward hard assets and equities. Basically anything that can hold its value while purchasing power erodes. So in this environment, it's not just greed, it's self-preservation. When currency loses strength, asset prices rise. In other words, when your dollars are worth less, it takes more of them to buy stuff. At the end of the day, this surge in leverage is a mirror. It is a reflection of just how bullish sentiment has become. But as we saw on October the 10th, that leverage is a double-edged sword. Used responsibly, it can multiply your returns. Used recklessly, it can erase years of gains in hours. So while optimism is high, I would encourage investors to use much, much more caution, especially if you're trading on borrowed money. Ultimately, this entire cycle, from the money printing to the AI bubble, can be traced back to the same two forces: fiscal excess and technological hype. So on the fiscal side, one thing we look at is the U.S. M2 money supply. That's how many dollars are out in the system. And it is again growing at a 5.1% annualized rate. That is fresh liquidity. It's trillions of dollars pouring into a system that is already stretched by speculation. Then you combine that with this AI revolution, undoubtedly the biggest technological advancement since the invention of the internet. And when you put those two things together, you have the perfect cocktail for both innovation and also wild volatility. The bottom line is this: we are living through one of the most leveraged, momentum-driven markets in modern history, powered by debt, technology, and wildly optimistic beliefs. It has been and continues to be a new era of opportunity, but also one of increasingly high risk. And as the line between smart investing and speculation blurs, the question is not if the system will test its limits, but when. So you might be watching this and saying, Ross, well, you're saying we're near the top of a bull market. Shouldn't I sell everything? Well, here's the thing. If you go back to like the 1999 peak there, the top of the dot-com bubble, the NASDAQ index doubled the year before the top. So they got to basically where we are now. Market doubled again. That's the wild speculation. And here's the risk with these kind of crazy markets. If you don't play them, man, you're going to miss out on a lot of money, a lot of profits and growth. But you have to know it's going to cut back in a big way. And so you have to remain kind of nimble. I don't mean by the hour. I don't mean one day, but you got to be a little bit light-footed. And you got to be ready to get the heck out when things start to crash. So what do you think? Are we early stages of this super cycle in the market, or is this simply the calm before the storm? Drop your thoughts in the comments. I read every single one of them. And if you want to stay ahead of these market shifts before they hit headlines, make sure to follow this channel, turn on notifications, because the next move is already forming.